Well, you probably either just got back or are still waiting for your tax refund checks, and or you notice the ones you paid have just cleared, perhaps at an amount that was surprisingly different, and you probably looked at the form, whether you filed it or not, and noticed it looks quite a bit different. When you look at the backside of this newly revised federal income tax form, it starts off with your taxable earned income from wages, less the set aside up to maybe 20% for your pension, and there may be another employee matching. That doesn't show until you go to withdraw it. That will be treated like a mandatory taxable distribution, which we'll see. You will have interest income, which is either fully taxable. That'll be treated the same way as, say, we'll find with the mandatory taxable distribution. And you may have tax-exempt interest expense, which, if in the same state, would be exempt from both federal and taxable. And watch out, those federal bonds are not taxed by the state, but are taxed by the federal government. You may have qualified stock dividends for USA stocks. They get a special treatment with a lower tax rate for the federal. You have the mandatory distributions, starts at the age generally of 70 and a half, and that's for your pensions and your fully taxable IRA accounts. Of course, the Roth, being tax exempt, has no taxes at all, which means those tax exempt instruments we referred to earlier should be kept in a cash account. If you have Social Security benefits and you're in the middle income tax bracket, you will have an exclusion of maybe 15%, meaning only 85% of that portion of the Social Security is taxed. Heads up, some states do, some states do not tax Social Security. We'll look at that later. Let's do some numeric examples, starting with earned income, with, let's say, a pension set aside of 20%. Let's say you made $100,000. Federal tax rate for a lot of middle class payers will be around 27%. For a state that has a relatively high income tax, like California, might be around 9%. I rounded. And let's say you made $100,000, you set aside the 20%, so you're taxed on the $80,000 at a total tax rate of 36%, and so the tax would be 28.8, and you would have after tax in that case 71.2. Skipping the interest expense, whether taxable, non-taxable, taxable just by the Fed, depending on the state, should be the same state if it's tax-free for the state, and again, it's treated as a totally taxed like the mandatories or tax-free like the Roth. So for qualified dividends, that's for USA stocks, it's taxed at a lower tax rate, 20% for typical middle-class taxpayers. So that's 29% total, times, say, in this example, qualified dividends again on USA stocks of, say, $25,000, and well, that would be 7.25, leaving you after tax 17.75. For distributions from a pension plan or a traditional IRA account, does become mandatory when you hit the age of 70 and a half. Has the same treatment as fully taxable interest payments, and in this example, let's say we have $10,000, and that's the 27 plus the 9, 36% times 10, well, that's 3.6, and you keep 6.4. And of course, again, the Roth is tax-free. And also, if you have a tax-free federal and state, that means same state account, that means you should put that in a cash account. Don't shelter those. For many middle-class taxpayers, Social Security benefits have a 15% exclusion, meaning you're taxed on the 85%. Some states do, some states do not tax Social Security. In this case, we'll use a state that does not tax Social Security, so you only have the 27% federal and 85% of, let's say in this case, some $30,000. So that works out to be 6.885, and you keep 23.115. So what does this all mean? Here are the effective marginal tax rates. If you set aside 20% of your income in a pension, you'd pay 28.8. Qualified dividends, 29%. Tax-free interest, tax-free, fully taxable, the 27% federal. Nothing on the Roth or tax-free interest, and the mandatory, well, that's 36%, and roughly 23% for your Social Security. Here are the states that do not tax Social Security. Here are the states that do tax Social Security. And here are the states that have no income tax. And here are the states that have a high income tax. So, as the phrase goes, your mileage may vary. Well, this is Dr. C, keeping you up to date. You know, it's been often said, not only do you want to lower taxes, but you also want to make a better plan for them. And what better time than now?